Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
In today's episode, you'll learn about, first, today's US market review. Markets recoil as a massive rotation rocks Wall Street. Tech stocks are plunging while smart money quietly floods into value sectors. Is this a healthy correction or the start of a tech bloodbath? Second, Ford's $19.5 billion EV bloodbath rocks the auto industry. The automaker is taking a record-breaking write-down, but is this a sign of catastrophic failure or a brilliant pivot that Wall Street is about to reward? Finally, the $10 billion shadow war, how 3 22-year-olds became billionaires by exploiting AI's hidden weakness, will reveal the secret picks and shovels gold rush that's booming and why a former giant in this space saw its market cap evaporate by 97%. Listen up, the markets are on edge today as critical data releases loom and the Fed's recent rate cut has everyone scrambling. The S&P 500 slipped 0.2% yesterday, but that's just the surface. Underneath, a massive shift is underway. The Nasdaq took a beating, down 0.6% as tech stocks face renewed pressure. I'm telling you, this is a pivotal moment. Smart money is repositioning and you need to act now. Why are we seeing this rotation? It's all about the Fed's December rate cut and upcoming economic data. The Fed dropped rates by 25 basis points, but don't let that fool you into thinking we're in for a dovish ride. Chair Powell's cautious tone suggests further cuts aren't a done deal, especially with inflation still above target. This week's data releases, including delayed non-farm payrolls and the Consumer Price Index, are set to redefine 2026 rate expectations. If payrolls come in over 100,000 and CPI remains stubbornly high, tech stocks will likely face more pain. On the flip side, disappointing payrolls and cooling CPI could spark a tech rally. Keep your eyes on these numbers. They're the key to unlocking market moves. The Fed's policy shift is reshaping money flows. We're seeing a massive rotation out of high valuation tech stocks into value and cyclicals like financials and basic materials. Financials are thriving with the XLF up over 2% as higher rates boost bank margins. Meanwhile, the tech-heavy XLK is feeling the heat. The VIX is ticking up, signaling rising volatility. Investors are hedging against uncertainty as long-term rates stay elevated, compressing valuations for growth stocks. This is your wake-up call. Don't get left behind in the rotation. Sector-wise, basic materials and financials are leading the charge with gains of 3% and 2.4% respectively, driven by strong industrial demand and elevated interest margins. Tech and communication services, however, are on the back foot, down 2.18% and 1.63%. Company like Broadcom took a hit, dropping 11.4% post-earnings due to margin concerns despite strong revenue growth. Contrarian plays like Tilray Brands soared 65%, capitalizing on valuation resets. Watch these dynamics closely as they reveal where the smart money is flowing. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. It's time to recalibrate your portfolio. Short term, if payrolls surprise on the high side and CPI sticks underweight tech by 15 to 20%, focus on financials and value stocks, adding 3 to 5% to XLF and IWM. Medium term, if data points to easing inflation, overweight growth with a 5 to 10% increase in tech, targeting QQQ. For defense, if the VIX spikes above 22, hold a 12 to 15% cash position and hedge with VIX calls. Advanced investors can use put options on QQQ, while intermediates might consider SQQQ for downside protection. Basic investors should increase cash and rotate into defensive sectors like XLU and XLP. Time's ticking. Today's economic data will set the tone for early 2026. Don't miss the opportunity to position yourself ahead of the curve. Stay alert and be ready to pivot based on how these numbers unfold. Now let's dive deep into today's critical market dynamics. Ford just announced it's taking a massive $19.5 billion charge in a stunning reversal of its electric vehicle strategy. The Detroit automaker is hitting the brakes on its all-electric ambitions, writing down $8.5 billion in EV assets alone. This is a huge pivot from the Ford Plus growth plan, which was built around an all-electric future just a few years ago. We previously analysed how the rollback of US fuel efficiency targets gave legacy automakers breathing room to slow down these capital-heavy EV build-outs. Well, this latest development is Ford using that exact policy window to formally reset its roadmap. Now, a $19.5 billion charge sounds like a catastrophe, right? However, if you zoom out, you'll see another layer of strategy at play. It's a concept called addition by subtraction. For years, investors rewarded growth at all costs, but the mood is shifting. The market is starting to reward companies that cut their losses on unprofitable ventures to focus on immediate profitability. Believe it or not, Ford even increased its forecast for adjusted EBIT, a measure of core operating profit. By taking this huge one-time loss now, they're signaling to investors that they are getting serious about profitability and the market may actually like it. So what's the new plan? The company is refocusing on hybrid vehicles and cancelling plans for a next-gen large all-electric truck. Instead, they're aiming for smaller, more affordable EVs. In a statement, CEO Jim Farley called it a customer-driven shift, which directly echoes his earlier praise for the rollback of fuel efficiency standards. This pivot to hybrids isn't just a Ford story. It's a trend across the industry with some interesting economic consequences. The rapid price drops we saw in EVs were actually helping to cool down inflation. With automakers like Ford slowing down on pure EVs, that deflationary pressure could ease. This could create a stickier floor for prices, making it just a little bit harder for the Federal Reserve to get inflation all the way back to its target. So a shift in car strategy could have ripple effects on interest rates for everyone. But the real admission came from Andrew Frick, a president at the company, who said, Ford is following the customer. We are looking at the market as it is today, not just as everyone predicted it to be 5 years ago. That's exactly what we discussed when legacy automakers began de-risking their EV investments after the regulatory reset. This strategic shift has huge consequences. The iconic all-electric F-150 Lightning will now become an extended range model that includes a gas-powered generator. And here's where it gets interesting. Ford is also repurposing battery plants for a new stationary energy storage business. This move is a direct response to immense global competition, particularly from China. For instance, BYD is selling its Seagull EV for as low as $7,800 US, a price point American manufacturing currently can't touch. This growing gap could trigger more protectionist trade policies from the US. Actually, the move to repurpose battery plants is a brilliant diversification strategy. Ford is entering the business of battery energy storage systems, or BESS. These are giant batteries that help stabilize the power grid. And with the rise of renewable energy and AI data centers, the need for them is exploding. This means Ford won't just be competing with GM and Toyota anymore. It will be competing with energy companies. Ford now says it doesn't expect its EV division to be profitable until 2029. And by 2030, the company projects that a full 50% of its global sales will be hybrids and EVs, a massive jump from an expected 17% in 2025. This isn't just a production change. It's a public admission that the all-electric future has hit a speed bump. This really highlights a critical challenge for the industry, something analysts call policy whiplash. The US green transition is highly sensitive to political cycles. It's tough to make a 10-year investment plan when government incentives can change overnight. The real indicator to watch from now on will be the sales ratio of hybrids to pure EVs that will tell us the future direction of the entire auto industry. Speaking of major industry pivots, let's go from a legacy giant hitting the brakes to a story of explosive acceleration in the tech world. Three 22-year-olds just became self-made billionaires. Their company, Mercor, hit a stunning $10 billion valuation, claiming the title of the fastest growing company of all time. Now, get this. According to industry research, Mercor went from just $1 million to a $500 million annualized revenue run rate in only 17 months. This kind of hypergrowth is almost unheard of, but this isn't another social media app. They're at the center of a shadow gold rush happening inside the AI boom. While labs like OpenAI burn billions chasing artificial general intelligence, the real profits are flowing to companies selling the one thing AI can't create itself: high-quality human data. This is the classic billion-dollar picks and shovels play of the modern era, and its significance goes beyond just one company. The growth of these data firms is now a crucial barometer for the entire AI industry. Their revenue directly reflects how much capital big tech labs are spending. If companies like Mercor slow down, it could be the earliest warning sign that the AI investment frenzy is peaking, signaling a correction long before big tech officially reports earnings. Industry insiders estimate AI labs are spending over $10 billion this year on training data alone. The competition is ferocious. A rival, Surge AI, reportedly took in over $1 billion in revenue and is now seeking a $15 billion valuation. The battle is so intense that a major player, Scale AI, is suing Merkle for allegedly poaching an employee and stealing clients. The market exploded after a deal involving Meta was described as breaking $1 billion piñata over all the data startups. One competitor saw demand triple overnight. This situation presents a fascinating duality. On one side, massive investment, while on the other, a recent MIT study found that 95% of businesses using generative AI have seen zero return. Why? Because models that can pass the bar exam still can't be trusted with real-world tasks. So AI labs are paying premium prices for armies of experts, from analysts to engineers, to create millions of granular criteria, essentially teaching AI how to think. This is where the situation takes a more complex turn, revealing a fundamental shift in how we should think about AI's evolution. It all comes down to something called Moravec's paradox. Tasks hard for humans are easy for AI, but tasks simple for humans are incredibly hard for AI. This is why the dream of a self-improving AGI remains distant. Instead, AI is developing more like a normal technology, needing continuous human input. This challenges the simple narrative that AI will replace all professional jobs and implies a more durable demand for these data companies. This frantic demand has created a bubble of opportunity, but also extreme risk. One former industry giant, Appen, saw its market value collapse by 97%. The story of Appen's collapse is a cautionary tale that's often misunderstood. It was a leader in simpler data labeling, which became a race to the bottom on price. They were also heavily reliant on a few big clients like Google, and when a major contract was terminated, their business model fell apart. The crucial test for companies like Merkle is whether providing complex, expert-level data can create stickier client relationships and avoid the commoditization trap that doomed Appen. For now, the money's flowing. As one CEO put it, the goal is to turn the entire economy into a giant reinforcement learning environment. So, where does this all head from here? One major trend to monitor is the geopolitics of data. This high-value data boom is very US-centric. Logically, we will likely see other major players, including China and the EU, accelerate their own sovereign data initiatives to build up their domestic data supply chains. This could create a new front in the global tech competition, influencing AI standards worldwide.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.